The biggest drivers of Solana this week may have nothing to do with blockchain upgrades. Instead, the story is shifting towards liquidity, institutional capital, and macro uncertainty. Understanding where professional investors focus their attention often provides a very different perspective from following headlines alone. We'll first look into the event and then the chart through the Wyckoff lens. From a market structure perspective, Fed policy becomes less predictable, meaning volatility itself is not automatically negative. Solana's active DeFi ecosystem often benefits when trading activity increases. The evidence that strengthens this thesis would be improving on-chain activity alongside stable market liquidity. From a certified fraud examiner perspective, liquidity conditions matter more than narratives. If market makers widen spreads because macro uncertainty rises, price swings become much more violent. Institutional desks will likely monitor liquidity quality rather than simply headline direction. Macro liquidity sets the backdrop. Now let's see what traders are watching directly on the chart. Solana challenges major technical levels. Technical recoveries often fail during uncertain macro regimes. Institutions typically require confirmation across multiple signals instead of reacting to a single moving average. Evidence weakening the bullish case would be repeated failures to hold reclaimed support. From a systems engineering perspective, algorithms frequently operate on predefined rules. Reclaiming both major moving averages may reactivate trend-following strategies. Professional traders will watch whether buying volume confirms the breakout rather than focusing only on price. Charts tell us where traders are acting. The next question is where capital is flowing. The competition for investor capital intensifies. Capital rarely disappears permanently. It rotates between sectors depending on perceived opportunity. A broad recovery in risk appetite could eventually benefit higher beta assets like Solana. The MBA framework here is simple. Follow incentives, not headlines. If healthcare and industrial stocks continue attracting speculative money, alternative digital assets may struggle to regain momentum. Institutions monitor capital allocation trends much more closely than social media narratives. But traditional markets aren't the only competitors. Technology itself is attracting enormous investment. Physical technology draws investor attention. Massive funding rounds in space and communication infrastructure compete directly for institutional capital. That does not make blockchain weaker, but it changes relative opportunity costs. Large investors constantly compare where each incremental dollar is expected to generate the best risk-adjusted return. Longer term, expanding communications infrastructure can also benefit decentralized networks. Better connectivity improves the environment in which blockchain applications operate. Execution remains the key uncertainty institutions will continue monitoring. Finally, we arrive at what could be the biggest structural development. Institution capital is being repositioned. Market resets sometimes improve long-term market quality by reducing leverage and encouraging stronger governance. From a CFD perspective, healthier controls often matter more than rapid growth. Institutions generally prefer durable participation over speculative surges. Portfolio restructuring rarely finishes overnight. Structural selling can continue long after headlines fade. The strongest confirmation that this pressure is easing would come from stabilizing institutional positioning rather than short-term price rallies. Remember, you can join the other channel members and get early access to these videos, and you can find my weekly write-up on Substack at AssetLens. Let's dive into the chart. This is the big picture of Solana's chart, and from a Wyckoff lens, it is at its early stage of accumulation. If what we have gone through in the past 4 weeks is the selling climax stage, this climb this week that we're having may be a test or a climb towards the automatic rally stage. It's too early to tell because it can be just a short-term rally and then return down to below the key level of $75, the purple line here, to retest the $60 before it really climbs up for an automatic rally. Sometimes it happens that way. So look at what happened over here. After the preliminary support, coming back down to the selling climax, it went sideways with small climbs before it gets to the automatic rally. But of course, this can also be just the automatic rally if it is really just stopping at somewhere in the midline between $75 to $89. Anyway, it is the early stage of accumulation cycle, and we expect more tests to come in the subsequent period of time. And go to the micro view, the daily chart, we can see we talked about the potential range bound situation between 60 and all the way actually to 89. Well, actually 60 wasn't really expected other than that, the previous 2002-2004 accumulation cycle dropped to that point, because the actual short-term support for 2026 at least was set by the February 6th date of $67. So last week when the price got rejected twice by the purple key level of 75, the price came back to this $67 level. Okay, retested it for 2 rounds before it surges back to trying to retest the $89. So it's time to extend this yellow dash line, because today, and actually even yesterday, rejections came in around this level at around $82. This is the center line. You can say the center line where the sideways trading between February to June. Okay, you see this line, a lot of occasions where you see support over there. Okay, that's where it is now, because the price is below it. That's why we're finding it as resistance for 2 days. So before testing 89, there's $82.70. This yellow dash line is the short-term resistance. So you can see even over here, before the price dropped in the beginning of June, this line has been tested for 5 days. The boost failed to climb above the line, and then that's decline started. So while it is climbing, let's measure whether or by when we'll get an answer. The change or continuation of trend decision, right? It is still early. It is climbing along the ceiling of the uptrend. So to climb or to trade sideways towards this wedge, it is going to take a few more days. That's pointing to the 8th of July. All right. So if it trades towards here, continuing to be rejected by this yellow dash line, by July 8th, we will have the answer, because either it breaks the resistance to continue with the trend. That's the first C. The second C is to change the trend, either sideways or come back down to below the $75. So by sometime middle and next week, we'll get the answer whether it'll continue to climb up or it's going to get rejected in the next few days, and the tendency to come down in that case will become slightly higher. And by looking at the price chart and the news that we covered, these developments should be viewed as scenarios rather than predictions. Okay? Professional investors typically evaluate incentives, liquidity, governance, and execution risk before drawing conclusions. As always, this discussion is educational and based on historical relationships rather than investment advice. See you in the next video. Thank you.